You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody. That music means it's time once again for Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-evolving Options Insider Radio Network. 14 programs now, including our latest This Week in Futures Options, recording in a couple hours at 3 p.m. Central. So if you like this one, tune in for that one as well. We get into the volatility of all the fun futures options products. Soybeans lighten it up these days, but crude oil, metals, just about anything you can think of that falls under the futures options tab. We will talk about that. You can find that pretty much wherever you find your favorite programs, including Volatility Views. That's our website, theoptionsinsider.com, iTunes, TuneIn, Stitcher, and so on and so forth. Of course, also via our mobile app, available in all your favorite app stores, including iOS and Android, and even everyone's favorite, the Fire OS. All three of you out there rocking the Kindle Fire tablets. We got a version for you as well. And joining me on the old program today, starting off, it's been a little while. He's been hither and yon, and he hasn't, quite frankly, paid his Skype bill, but now he has, so he's ready to roll. Beaming in, not from his palatial corner office, but actually from somewhere, I believe, in San Diego, somewhere on the West Coast, is formerly corner office fame, Mr. Russell Rhodes, the senior instructor over there at the Options Institute. Russell, welcome back to the program, A, and then B, where the heck are you today?
I'm in San Francisco, and I'm going to tweet a picture of what I'm looking at right now as soon as you throw it to somebody else. I'm out here for an OIC event tomorrow morning, and I'm going to spend the afternoon with one of our sponsors, with LiveVol, and talk to them a little bit more about how we can incorporate our partners at LiveVol into some of the things we do at the Options Institute.
Well, just Russell, be advised that we're trying to avoid the explicit tag, so I don't know what you're going to tweet out, but just make sure it's clean.
Yes. He would know of that. That is, of course, the Greasy Meatball there chiming in, Mr. Mark Sebastian from OptionPit.com, as well as from Carmen Line Capital, Carmen Line Wealth Manager. I'm not sure what the end of that is. Mr. Greasy Meatball, welcome back to the program, to you as well, sir.
It is Carmen Line Capital. Thank you very much. We are not a money manager. We're a fund.
Is it capital with a K, like the cool kids do it? Like
no,
Mortal Kombat?
No, but Carmen is with a K.
Oh, okay. Well,
so you've got that going. Things are good. I'm enjoying this great weather, this great thing. Trading's been great. You might even say that trading's been super great. as in there's been some super trading for me. But
I don't know what you're alluding to, sir.
All is well in my world, friend.
All is well on the Volatility Views program, too, because we have a great guest. So let's get to it and dive right on into our Volatility Viewpoint.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, welcome to Volatility Viewpoint. Like the man said, this is the portion of the show where we welcome on guests from throughout the world of volatility trading and research and analysis and all of the above, and proceed to pick their brains for the benefit of you, the listeners. And today's guest is a newcomer to the show and indeed to the network. He is Taylor Lukof, the CEO of ABR Dynamic Funds. Taylor, welcome to the Volatility Views program.
Thank you, Mark. Thank you very much. And I guess before we get started, our regulators would like us to inform everyone of the following, and we can get this out of the way. Consider the objectives, risks, and charges carefully before investing. Prospectus contains this and other information about the investment company. You may obtain a prospectus by calling 1-855-422-4518 or visiting our website at volfunds.com, and the prospectus should be read carefully before investing. So now that we've got that out of the way, thank you again for having me on, and we appreciate what you guys are doing to get the good word out about volatility trading.
I think you may have set a first for our network. Taylor, I can't recall the last time a guest came in, and before he even introduced himself, read a disclaimer. So you definitely have right of place in having the most active compliance arm. I'll give you that.
We are very active in compliance, and obviously that's paramount right now. So brief introduction to who I am. I am the CEO and founder of both ABR Dynamic Funds as well as our parent company, ABR Management. And ABR Management is an RIA, and we're focused on systematic quantitative trading. And we have been running now for a little over 4 years. And we basically are developing systematic quantitative tools in both volatility trading and ETP trading for our clients in what we call the blended portfolio strategy. And about a year ago, we were fortunate enough to launch our subsidiary, ABR Dynamic Funds. So what ABR Dynamic Funds is doing is essentially licensing the algorithms from our parent company, building indexes, and then figuring out ways to create investable assets for our clients. So that's a quick background on kind of what we're doing. And our background is former equity option market makers and specialists. Most of us met down on the floor of the Amex in the early 2000s. So that's where our background in volatility lies.
Yeah, what pit were you in the Amex?
So I was actually a specialist for a group called Tanstoffel Trading, which was an acronym for there ain't no such thing
there ain't no such thing as a free lunch. Right, Tanstoffel.
Right.
I was a market maker on the Amex for a couple of years, so I was down there probably about the same time.
I don't think I ever saw you in our crowd, but I'm sure you were down there somewhere.
Yeah. Were you guys in Harry's, or were you way up on the deck?
We were on the first floor in the back, standing across from the LeBranch specialists.
Ah, okay. All right, I see where you guys. So you guys had like BBH and some of the other stuff like that, right?
We actually, I don't know that we had BBH, but we had a lot of the bond products. So we had TLT, SHY, IEF, and a lot of the China products in the early 2000s, CINA, CHA, CHL, et cetera. So we were focused on China, bonds, and then my specialty was biotechnology stocks.
Oh, fun.
Well, before we break up this reunion of old school Amex guys, being an old school SIBO guy myself, I relish breaking that up. But still, let's get into what we're actually talking about here today, which is, of course, your Smart Volatility Fund. You guys just put out a big release kind of launching this very recently. And as the name implies, this fund attempts to kind of take some of the legwork out of trading vol, or perhaps even, as you say in your release, remove it as a one-dimensional threat for a lot of the retail public out there in particular. And this fund is composed of S&P 500, so you use SPX products in there, as well as some VIX exposure in there, probably the options or the futures, I don't know, and also some cash exposures. And what's interesting about this, the reason why we wanted to have you on, obviously, is because you guys kind of adjust that exposure on the fly. So as a retail guy, you come in, you just buy this fund, and then it will effectively do a lot of that work for you, at least as that's what it's designed to do. So it'll determine whether to be heavy on the volatility exposure, heavy on the equity exposure, or perhaps just retreat to cash altogether. So a bit of an active management type play. So walk us through a little bit. Obviously, for a lot of our listeners, that probably sounds intriguing and also, I'd imagine, very confusing. Walk us through what you use to determine these allocations? Is it the VIX futures? Is it the VIX options? Obviously, you said SPX, so you got the options going there for the equity proportion. And then how do you start playing with this balancing over time? You rebalance, I believe, daily, so it's a very active thing you have going on. How do you come to these different allocations?
Sure. So there's a couple things you said in there that are a little bit different in construction. So we actually are not considered an actively managed fund. We are index tracking. So stepping back to kind of how this fund works is the purpose of it is investors are seeking a way to get exposure to volatility. And if you look at products like VXX, the shares outstanding fluctuates very dramatically when there's a lot of volatility in the marketplace, or even right now when there's a little bit of volatility and the VIX is below 15, you're still seeing increased exposure to VXX. And investors are seeking some way to systematically add volatility to their portfolio, and it's not really possible with what's out there currently. So what we're aiming to do is give people a static allocation of volatility, and then our algorithm dynamically rebalances back and forth between the S&P and VIX exposures. So to answer your question about how we gain our exposure, so it's long only. Our S&P exposure, our equity exposure is through the S&P, the front month of the S&P futures. And then our volatility exposures are expressed through the front 2 months of the VIX futures. So we're not actually using any options in this, but of course the VIX is representative of the S&P 500 options. So options do play a big part in what we're doing. And from time to time, we can go into cash. So the rules, I guess, of what we're doing are we can have exposures of up to 100% S&P or up to 50% VIX. And we're always fully invested or 100% in cash. It's binary. From time to time, we can go into cash for about 1 to 5 days. And yes, we do look for a daily rebalance, but on average, our rebalance is a little less than 2%. So we can have larger rebalances, but in general, they're very small from day to day if there's any rebalance at all.
It's actually a smart way to do it is have an index that is effectively actively managed, and then have your fund track the index. It kind of removes you're a step removed from some of the maybe issues that could surround, and regulatory issues certainly that could surround some sort of actively managed product. So that's a clever way. I was going through your release and some of your materials as you were talking, and you have a little breakdown on your site of kind of your outlook for your fund, so potential investors could have some sense of how your fund views different environments. And according to the materials here, it says the fund's exposure to equity increases in periods of relatively low market volatility. The fund's exposure to volatility increases in periods of relatively high volatility, and at times the funds may briefly convert to a full cash position. That's kind of interesting. And that actually some of our listeners may find that a little bit counterintuitive. They may think, hey, wait a minute, high volatility, they want to retreat from volatility, and low market volatility, that could also correlate to high equity valuation. So therefore they want to maybe back away from that. But your fund is kind of doing the opposite. So walk us through the mindset there. Why is it constructed that way, and why have you come to those particular goals for your fund?
Sure. So one of my colleagues, Dave Skordal, recently wrote a white paper on the dynamic management of volatility, which you can find on our website, volfunds.com. And we talk about some certain inherent principles of volatility that are a little bit counterintuitive, as you just mentioned. A lot of people think that the VIX is 20 over time, and when it's below 20, buy it, and when it's above 20, sell it. Well, buy low, sell high does not work with volatility. The VIX should be bought when it's high and sold when it's low. And that's a little bit counterintuitive, but low does not necessarily mean cheap. And we go into it in more detail in our paper, the math behind this. But what we're trying to do is give our clients exposures to equity in a bull market, and then give our exposures to clients exposure to volatility in a bear market. And it's really around those those turning points and how quickly you move in and out of volatility, that's important. And sometimes you don't have enough information about how much volatility or how much equity you should be exposed to. Those are the times where we go to cash until we can get enough information. And when I say we, I mean our algorithm. There is no manual discretion in any of the trading at our firm. So for instance, August 21st at around the end of the day when we do our daily rebalance, our mutual fund went to 100% cash. Now it looks pretty good with what happened on August 24th. We then took a few days in the model, and the model is saying, is this a systemic issue where we need to be long volatility for our clients, or is this an exogenous shock? For instance, the Russians shoot down, or whoever shoots down a plane over Ukraine, et cetera, and you just have a dip and then rally in the market. That's not when you want to be buying volatility for clients. So in general, you want to buy VIX when it's over 30, and you want to be short VIX or flat when it's under 15. That's part of our model.
Yeah, I think one thing that throws people off, Taylor, is, and I've had this experience, that if you just look at the median returns, so not mean, if you look at median returns, being long VIX above 20 doesn't look so hot. But if you look at the mean returns, where you really do get that fat tail above 30, where the VIX has the real ability to go to 80 and blow up, that the case then becomes so obvious that you want to be long when VIX is above 25 or 30, and vice versa on the on being short vol when VIX is below 15. I think people tend to look at kind of occurrences, and we want to spend a lot of time talking about, the mean of the VIX is 20. Well, kind of. I think some people would argue it's maybe 17, and Russell will tell you that it's the most common occurrence is in the 12s over the last few years. So I think a lot of people try and look at VIX like it's a stock, and volatility is a completely different animal from what we see in how stocks behave, which is why we always kind of laugh when we see people trying to do candlesticks and moving averages and Fibonacci's over VIX and VIX futures.
Yeah, and I think volatility is a relatively new product, right? So until about maybe a little over 10 years ago, you could get volatility exposures through the S&P 500 and the options on the S&P, but it's relatively new, and I think clients as well as sophisticated traders are kind of learning these new principles as we go. And to your point, Mark, a lot of people, they're looking for volatility as a hedge. They're looking for buy low, sell high, or some traditional methods. We see volatility as a driver of alpha, so a way for you to actually have a competitive advantage, not as a hedge to your portfolio. And in fact, the S&P is actually a hedge to our volatility trading in what we're doing in our mutual fund.
I don't think I've ever heard anybody state it that way. I like that a lot, though, that you could hedge your volatility using SPX. I think Mark, Sebastian, and I have talked about, possibly having an SPX trade on if you're worried about a spike in volatility, on the bearish side. The other thing I really like that you were talking about is the whole, selling volatility when it's low, because we hear that anecdotally at our risk management conferences an awful lot, but it's nice to hear somebody's actually quantifying it. And as you guys are talking, I am furiously scrambling around my laptop trying to find where I put the VIX closes by handle, where it shows that 12 or 13 is actually the most likely VIX close. And I'll tweet that out as soon as I can track it down.
Sure. And I think it's also important for people to understand that, everybody talks about the 60-40 model of portfolio allocation is kind of broken right now, right? So what does that mean? What's the new asset class? What's the solution? Well, you've got Treasury yields. We have a great graph that they're as low as they've been since 1876. And then you've got equity PE ratios in the 90th percentile. Rarely does that happen at the same time. So exploring volatility as an asset class is something that's never been more important than right now. And the issue is these static allocations just don't work. So if you look at VXX, for instance, which is down. And VXX is a great product for short-term trading, but obviously you don't want to buy and hold it. VXX is down 30-some% this year, 50-some% since mid-February. But VXX assets are about 5 times higher than they were in mid-February. Sorry, shares outstanding. If you adjust for the level of VXX, which is 50% lower, it's about 2.5 times more money in VXX now, or more exposure than there was in mid-February. And we all know what's happened to VXX. It's gotten completely destroyed over the last couple months, and yet people are still looking for that protection. We're giving them a model that says, look, you don't always need to be in volatility. There's certain times that make sense. So if you look at, and if you look at correlations of different asset classes, there's only 2 asset classes really of the main asset classes that are negatively correlated: fixed income and volatility. But if you look at the 2008-2009 crisis, fixed income actually became more correlated to the S&P 500. Volatility is the only asset class that actually became more negatively correlated during the financial crisis. So this is something that needs to get out to the general public, that volatility is that kind of, I don't want to say silver bullet, but something that needs to help replace some of that 60-40 allocation.
Well, and you know, one of the pieces that I was talking to a couple of bankers about this that I really like about VIX and volatility is that it's the only kind of against a 60-40 portfolio, it's about the only piece that can actually hedge off that basis risk that exists between corporates and treasuries as well. One of the things that I think threw people off during the financial crisis was they expected their bond portfolio to not correlate with stocks or to get stronger. And what happened was you had this huge split between government and corporate bonds, and it turned into, and that basis risk blew up on people. And so I think that you really see that volatility is and VIX futures and VIX options, and which are really all that's out there right now, is really the only way to hedge off a lot of the major pieces of a portfolio. And when I look at, just from a personal standpoint, when I look at what's going on in the market and where the real risk is, I see that corporate bond, treasury bond basis risk as being one of the things that maybe people aren't talking about that could be a major driver of something going on. I don't think it's going to be rates rallying on their own. I think it's that when yield starts coming back to treasuries, what happens to the people that bought 40, 50-year corporates from for a 3.5% yield? That's probably not what it was, but I think you get my point. Or junk bonds for under 7%.
Right, and when those rates start rising, and we had some interesting news this morning that actually made it less likely, I think in June, from a probabilistic standpoint. But when those rates do start rising, all these companies, all these corporations that are taking advantage of low interest rates to just buy back their stocks and drive this market higher, you might see both of these things happening at the same time, where rates go up and equities go down, and that's rare that you see that happen in a portfolio over an extended period of time. So I think it just makes a greater case for volatility as an asset class all around.
Well, Taylor, I'm glad to hear you come on the show and expound yet again on the merits of perhaps leaning a little bit longer vol when things are a little crazier and more volatile out there. That's something we've discussed on the past and expanded on the past many times on this program. In fact, I think we did it recently, or probably last time when you and Sinclair was on, and I remember tweeting about that very thing to our listeners as we were recording the show, and I had never seen so much vitriolic feedback against that notion that you could somehow buy volatility when the VIX seem to be somewhat rich, and that could somehow pay off in the long run. People have just this counterintuitive notion in their head that that's when exactly, once it gets above that, that mean that's always bandied about, that 20, that average, then you have to just start dumping VIX all day long. And it's kind of interesting to see a little bit of the counterpoint to that. But that said, we are recording this today on Friday, June 3rd. Interesting day in the markets. Things are selling off. We'll get into that a little bit. But I'm sure a lot of our listeners want to know exactly what the fund is up to right now. How is it positioning right now? We're at a level, the S&P right around 2095. 1395 right now. VIX Cash on the mid to low teens level, about 1390 or so right now. So how is the Smart Volatility Fund leaning right now? Is it leaning long equity? Is it leaning long volatility? Is it scurrying into cash? What is the fund up to right now?
Sure. So there's about 4 signals that our model looks at, and most of those signals, or all of them over the past month and a half, have been long, mostly equity, I would say above 90%. So things are looking good right now. But again, this can swing from long equity to long volatility in less than 2 weeks. So we can move very quickly according to the algorithm. But right now, the model has not gotten any signals to start moving into volatility. Again, that could happen very, very quickly. And I think, year to date, the fund is up around 1% with the S&P at around 3.5% or so. So it's not a significant drag on a portfolio to put that in as some sort of alternative or hedge, especially when you look at what drag straight volatility in the form of VXX would have been. So we're very happy with the performance this year.
Yeah, speaking of the performance this year, it was kind of, I guess, a somewhat underwhelming year until you got to May. You guys really kind of blew the doors off in May, and that kind of got you to that little bit better year-to-date performance, like you were saying. And, to what do you attribute maybe that earlier kind of drag on the performance and then that kind of outperformance in May? Did you guys tweak the algorithm a little bit, or is that kind of just was May just a more favorable setup for the way your fund is designed?
Sure. So regarding the algorithm tweaking, so we have a partnership with a group that's publishing our index called Wilshire Associates. Wilshire independently is calculating and publishing this index. So we are attempting to hold securities in the same proportions that are in that index. And so far, we've done it with about a 0.97 correlation. So we're trying to replicate that index. So we cannot tweak the algorithm whatsoever. We'd have to launch an entire new fund or new index or both. So there's no tweaking. It's kind of, it's in motion, just like any other passively managed ETF. As far as the performance this year, we're actually very pleased with the performance even earlier this year. If you look in January, we had significant outperformance of the S&P when it's on its lows. The S&P didn't keep going down. The S&P turned around and rallied, and that's where you got that positive performance in May and even in April that you're talking about, Mark. And so we've had approximately a 12% standard deviation, while the S&P's had about a 20. So we're giving people, even in a bull market, we're giving them positive returns. We're also giving them a lot less of a standard deviation or a lot less volatility in their investment. And then in a bear market, we would expect to have, or extended bear market, positive absolute returns. So it's not just a hedge in a bear market. We actually seek to make money for clients when that happens.
Well, Taylor, I'm glad we could have this chance to chat with you here at the top of the show about the ABR dynamic funds, but you have been brave enough, some might say foolhardy enough, to volunteer to join us for the rest of the program. So without further ado, let's keep on rolling right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we break down what's moving, what was shaken today and for the week that was from a volatility trading and analysis perspective. We are streaming this and recording this live right about middle of the session here on Friday, June 3rd. And as we are recording this, we are post non-farms, most of the major indices selling off. As a result, S&P off about 0.5%, Qs off about 0.5% as well, Dow off slightly less, about 0.3 percentage point, VIX Cash inhaling a wee bit up about 1/4 of a handle, right about 1390 or so. And in terms of non-farms and the weight to them, this one this morning certainly seemed to have a lot more eyes on it than recent because, of course, due to the recent comments coming out of the Fed that they are perhaps poised to do something very soon here in June. So this non-farms was seen by many as kind of the last big number going into that decision, and that this number blew the doors off. Well, then guess what? Rate hike, if not so so much, and we kind of got the latter. They were expecting about 158,000 new jobs there in May. They ended up getting 38,000, so dramatically worse. They're saying it's the worst report they've had since September of 2010. So that's why the market, of course, selling off a wee bit now. I don't like throwing around these probabilities, but they're all over the place. CME has their Fed Watch tool, and they pump that up, and they're looking at the Fed funds rates out there and the Fed fund futures. The probability of a June hike that they were pricing in was somewhere around, I think, 19%. That is now effectively zero, and July going from over almost 60% to about a third. So again, it looks like, at least for the June meeting, a Fed hike probably off the table. You never know. Miss Yellen and her crew could pop their heads up and surprise everyone, but this makes it certainly a harder case to make for them in that front. It was kind of interesting. We were actually talking about this on the option block yesterday, that in spite of the seeming resonance of this non-farms number this morning, we still saw a market that was not at all adverse to selling volatility going into the close on Thursday. It's not a typical scenario where people would want to keep their powder dry, maybe hold on to a little premium in their back pocket in case the non-farms did what it did and kind of surprised to the downside or surprised at all. And yet we didn't see that. There wasn't that traditional reluctance to sell premium. So a bit of an odd market still shaping up, and now post non-farms, it might even be odder, to use a technical term. Taylor, since you're our guest today, I'll give you pride of place. Walk us through what your thoughts are on, of course, the non-farms and its impact on the volatility landscape, and maybe anything else that caught your eye from a volatility trading or analysis or research perspective over the past week.
Sure. So when the jobless number came out, you saw a real quick spike down and in the market, and then you had the payroll number, and it looked like, we're headed for a much lower day with the sharp spike down, and vol spiked a little bit, but still volatility is just extremely low right now. I think that nobody's really afraid of anything surprising happening. I still think the probability, obviously, is still fairly low in the low 20s that we're going to raise rates in June. And there's not a lot of reasons to be that scared right now. There are a couple catalysts coming up. The Brexit, I think, is the biggest one that not too many people are looking at. The probability is closer to 4% in June now. Excuse me. But I think that the Brexit is something that really hasn't crept into the U.S. volatility markets yet.
Russell, I know you're a big watcher of all things non-farms out there, so walk us through that, as well as listeners, in case you're not streaming live, you're listening after the fact. Russell did tweet out a very cool image showing those VIX closes and the efficacy or the impact of the 12 handle out there. So maybe walk our listeners through that too if they're listening on demand and don't have a chance to follow along with all of our live tweets.
Well, sure, I'll talk Fed and then that. Just because my thought on the Fed is I'm always coming up with out of control, wacky ideas here. If they do any movement whatsoever to the upside, I think the next statement you'll hear is, and that's it. Or something like that. Like they want to get something out of the way, want to be out of the way through the election season, and that's the only chance that I could see. And I know that I am very much in the minority, since the CME Fed indicator is basically 100% nothing's going to happen. Now, I tweeted out a picture that Mark Sebastian brought up, or what he was talking about a while back. This thing's about a month or so old, but I took a look at the most common closes for VIX by the handle, or the first two numbers, because everybody always throws that 20 number around, and that is a good long-term average. But the most common close for VIX starts with a 12, and if you combine the 12 and the 13 and the 14 handles, you get almost a quarter of all VIX closes in that range. So it's not like a neat bell curve of distributions around that average of 20. It kind of looks like something that Evel Knievel would have tried to land on and possibly missed for the cameras back in the day.
It looks like an evil version of Devil's Canyon, or whatever he would jump over there in the past. You're right. Check that out. We retweeted it as well, listeners, so you could find it there if you don't deign to follow Mr. Rhodes there on Twitter. And last but certainly not least, Mr. Greasy Meatball, what caught your eye in the week that was from a volatility perspective, sir?
Yeah, I mean, I think one of the interesting things was, every time they kind of tried to come in and sell it, which they did the last couple days, it got bought. And today might be the first day where it doesn't get bought again. I think right now we're down about 11 handles. I think we're going to soften into the close. And I'm not sure that you're going to get a crack at vol this cheap. Now, the other thing that I did that really struck me, and I talked about this multiple times on the blog, is VVIX levels have been really consistently as low. I mean, I've not seen a 5-day stretch of VVIX this low in a long time, and it touched an 18-month low last Friday and has kind of sustained that level. I mean, right now, VVIX up about $0.50 to about 80. I think it's going to creep a little higher from here, which puts it at the low end of areas when it was trading kind of middle of last year before this July, before all the Greek mess, which led into the August mess. So as I look, I think that there is, for those looking to hedge that want to set up hedges, the cheaper option is in VIX, where vol is low, and actually skew has come off significantly in VIX options relative to where it's been over the last few months. I was, anecdotally, one of the ways I kind of think about VIX just in my head, so I don't have to run some sheet all the time, I kind of think about how many days to expiration can I execute a 5-point vertical, a 5-point back spread for even money. So when can I sell one and buy two for even money? And over the last 4 months, that's been about 40 days. And most recently, last Friday, and then Monday, and then Tuesday coming in, I could put the trade on for even money. So they were giving me an extra week to be long that 1x2 for even money. So the skews come in, vols come in. It hasn't necessarily done that in some of the longer term options in SPX, but in VIX itself, there is definitely a discount. Additionally, I don't see the June contract trading at a crazy premium to the VIX contract at this point. It's got 2 weeks, let's call it 12 days to expire, and it's trading at about $1 premium. And then coming in Monday, assuming we get kind of the weekend adjustment, it's really only trading about 50 to 70 cents above where the cash index is. That seems like a level that's maybe a little overly complacent. I would be, just from a kind of coin flip, what do I want to do, gun to my head type of trade, I'd probably be leaning long exposure to volatility here if I had to.
Well, it's the beginning of the month, and so it's also numbers time. We talked a lot about them on Option Block yesterday, some of the overall volume numbers for the options biz, and it was indeed a decent month, not a robust month, but a decent month. Overall volume up about 4% from our friends over there at OCC, but what caught our eye for this program in particular, that it is still good to be in the vol and index business, looking at some numbers coming out of the SIBO index options, of course, SPX, et cetera, over there at SIBO. ADV about 1.5 million contracts in May. That's up 8% from this time last year. So that kind of gets back to what we were talking about earlier. May, a decent month for the index business, at least. SPX had about nearly 900,000 contracts a day. ADV, SPX, of course, a meaty contract. So that's a lot of size going up out there, even beyond the contract size. That's up 13% from a year ago. And of course, in the VIX land, the options are up 3% from this time last year, so May of 2015, about 528,000 contract ADV. That's a number most options would kill for from an ADV perspective. And that's actually kind of light for what VIX has been up to of late. And the futures also lighting it up, about nearly 230,000 contract ADV. That's up nearly a third from a year ago. And interestingly enough, I know you guys added a lot of hours over there, Russell, over the past year, extending the hours for the VIX futures trading in particularly. A lot of people asking how that's impacting things. That got about 23,000 contracts in that extended hour period, which works out to about 10%, which was about 8% about a year ago. So there you go. So that a lot of that kind of also is buoyed by if there's events going on in those time zones that drive some volatility interest versus the focus being domestic. If it's the latter, then that number is probably going to be a little bit less than 10, a little bit more than 10, but it seems to fall right around that 10% level, which is kind of interesting too, given how we've discussed in the past the strong overseas contingent for products like SPX and VIX. For whatever reason, the products really resonate in the French institutional crowd, it seems like, and a few other things as well. We also talk a lot here about VIX Cash. Of course, we're hovering about 1380. VVIX also still on the low end of its range. VVIX, of course, the volatility of VIX. It has been as high as flirting well north, getting into or flirting with the 100 handle and a little bit beyond back in, I think that was about March or so when it got up to nearly 199. So we're on the lower end of the recent range out there, hovering south of 80, about 79 and a half or so. So volatility of VIX still on the downside, a little bit slightly higher than it was about a week ago, but still overall not exactly lighting it up from a vol of VIX perspective. Who knows? Maybe VVIX is a driver in the smart volatility fund. We'll have to put that to Taylor in a little bit. But before we do that, let's dive into, I think, everyone's favorite portion of the show, if not for no other reason than it's just fun to start it. It's time for Russell's Weekly Rundown.
Now, Russell's Weekly Rundown.
I've heard that a million times. I still laugh every time. All right, Mr. Russell, you know what to do, even though you haven't been on in a little while. Break it down for us from the West Coast. What's been lighting it up out there in VIX weekly options this week?
It's an East Coast, West Coast thing. Nothing. There haven't really been any new positions, but I do want to highlight some that were taken about a week or so ago, and it's kind of like varying positions using the weeklies that expire just after the next Fed meeting. Conveniently, Fed meetings seem to always end up on a Wednesday afternoon, and every once in a while, well, actually, it seems like more often than not, they end up on a VIX expiration Wednesday, and that's what's happening with the June contracts this time. So looking out to the June 22nd contracts, if you're going to do anything or based on excess or lower volatility around the Fed meeting, that's what you would look out to. And in this case, although I think I would, I'm supposed to be a company man and do nothing but talk about VIX options and futures, I actually think I would give some consideration to VXX or SVXY or UVXY as well. But sticking with the June 22nd contracts, on the 24th last month, had different positions come in. We had somebody buy the June 22nd 25 calls and pay 30 cents for them. And then at the other end of the spectrum, we had somebody come in and buy almost 12,000, I think, of the June 22nd 15 puts. And needless to say, they're looking like the smart guy right now. And they paid between 48 and 49 cents for those. So let's just say that they've got a break even of 14.50. They're looking really, really smart right now if we don't, if the Fed's on hold and the market adjusts for the Fed and then stays where it's at for the Fed as well. So that's, that's the best things I can find in the weekly market right now, in the weekly VIX market.
Things have certainly been lighting it up out there in VIX weekly land, and the mothership options also a decent week. Obviously, it started off weak because or quiet because there was no trading here in the States on Monday as a result of the Memorial Day holiday. Tuesday lighting it up about 655,000 contracts. Wednesday a little lighter, about 300,000. Thursday right around that magic ADV number of about 550,000 or so. We're seeing some interesting paper lighting it up this week. Not a ton, not a lot of the size stuff, but some interesting stuff. Some smaller players looks like they're getting in on the 1x2 game today out there in VIX land. Nowhere near as much size as our other friend out there who will do about 1 million plus contracts rolling her 1x2. But in this case, it's looks like we have the June 1823 going up a little bit smaller size, 9,000 by 18,000 today, as well as someone playing on the July 1620 doing that that 5,000 by 10,000 times, again, selling by buying. So some smaller players starting to dip their toes into the 1x2 short 1x2 waters out there, seeing the success that others have had out there. It's probably one of the more widely mimicked trades out there in VIX options land right now. I know we certainly talked about it quite a bit. Again, it's not effective in all scenarios and all environments, but it is certainly an interesting approach to what's going on out there in VIX land. On Thursday, one of the bigger trades we saw looks like a closing buyback of some near-term upside here. The June 22s gobbling up nearly 50,000 of those for about a dime. Looks like they were picking those bad boys back up to close them out. Ton of open interest on that strike as well. We also saw out there on Wednesday a bit of some funky trading out there on the June 27s. July 27s, about 23,000 of those going up, as well as, actually total of looks like about 40,000 of those guys going up, paper buying for about 50 odd cents, 52 cents. So a lot of diving in to some July upside there as well. And some other funky stuff going up earlier this week. Looks like a weird six-way went up in July SEP on Tuesday. Not for huge size, about 12,300 of the SEP 22 calls versus 12,300 of the July 22 calls. Paper selling those for about $1.10. Also selling the SEP 19 puts about 5,700 times, and then coming in on the SEP 19 calls. And then buying the July 18 puts about 4,000 times, and also putting up the July 18 calls about 4,000 times as well. So a bit of a weird, funky, you can call it a six-way, you can call it a couple straddle/combos versus some other legs. A bit of a funky one. We'll have to parse that one a little bit more. But some of the weirder paper that caught our eye, in addition to all of Russell's breakdowns from the weeklies and looking at what was lighting it up overall. What were the big hot number one, the top 10 VIX strikes for the week. Number one, again, the June 25s, 371,000 of those bad boys open up out there. So that's number one with a bullet on the old list. Number two, the July 30s, the ever optimistic July 30s, still lighting it up to the tune of about 318,000 contracts open there. Then we fall off a bit of a cliff to number three, the July 22s. We were just referring to these a little bit earlier, about 258,000 open there. The 210,000 of the July 30s, again, the optimistic 30 strike rearing its ugly head. Number five, the June 20s, about 185,000, all the way down to number six to find our first puts on the list. The June 15s with about 183,000. So again, about roughly half of what's open on the number one list number here. Number seven, the AUG 30s. Again, the 30 handle resonating in people's minds. About 176,000 open there. Number eight, the July 23s, 155,000. Number nine, our second put on the top 10 list. Two this week. That's a record high for at least recently. We haven't seen a lot of puts on the top 10 of late. Again, gets back to what Russell was referring to earlier. The June 17 puts going up 152,000 of those bad boys. And then rounding out the top 10, the June 23s calls, 150,000 open. Total about 6.8 million contracts open, about 4.8 in the calls, and about 1.9 for open in the put realm. So not record open interest numbers as well, but still fairly strong, all things considered. All right, before we move on to other stuff, well, actually, we still are a little bit in the tail end of earnings season, even though we don't have a lot of big names coming up, still lighting it up anymore. So really quickly, maybe Taylor or perhaps Russell, if any earnings volatility is catching your eye out there, any single name volatility, now is the time to raise your hands. Russell or Taylor, any of that catching your eyes?
Well, this is Taylor. We don't trade any single stocks at our firm. We just don't think we can get. We've moved away from that model for the most part, so we're not really focused on individual name volatility. But Russell might have some opinions there for you.
It's quiet. I'm still here. It's quiet. We're kind of in the middle of earnings season. Or I'm saying between earnings seasons is what I was trying to say there. I think we only had 4 or 5 stocks this week with weekly's report, and I think we've only got 5 next week as well. So it's just quiet, too quiet out there.
You know what I saw that was kind of funky, Mark? We talked about those mosaic calls that went up a couple weeks back when a timely trader 2 days before expiration bought just a ton of the weekly calls. We saw a similar trade in Xilinx yesterday. A customer came in, was buying yesterday.
Yeah, they were dailies.
Basically they bought the June 3, so expiring as we speak, 48.5 calls. They bought them from like 10 cents all the way up to 19 cents and didn't close them. Those are at 4 cents. I don't know what that customer was doing, but it was really funky and super tradable. It worked out great. But one lesson I would give, and I know Taylor agree with this from his old market making days. When you get a customer with a huge axe to grind, you give him the grinding. You let that customer buy as much as he or she wants, just as long as you smartly hedge around it and pay attention to the vols around it. But if you can buy 30 vol and sell a customer 65 or 70 vol, probably going to work out in your favor.
Right. And, I just had somebody IMing me as you were talking about that, Mark. There's a big trade in XLF that's going up today. I don't know that we've mentioned this yet. They're looking to sell the June 30 puts, the July 22 puts, to buy the August 23 puts. And this is a big trade they're looking to do. 140,000 by 45,000 by about 20,000. Very significant trade. He just sent it across. So I'm still trying to decipher exactly what they want to do. But it looks like they're trying to buy August volatility in XLF or some sort of hedge.
Well, I mean, it makes sense if you think about last year's August was quite the experience. And it's still, you still get exposure to that whole Brexit. And I agree with you. I think Brexit's underpriced. And it lets you, have kind of a bearish standpoint and kind of pay for that August exposure to some degree. So I like that as a trade a lot. And I am continue to be shocked that nobody is worried about this vote. I think there is real potential for that to turn into a mess.
The poll, I think, was something like 52 to 48 in favor of leaving. Most recently that came out. And I think the volatility in the British pound went from about 10 to 20 pretty much overnight with that vote. So clearly somebody's looking at this, but that has not yet bled into the U.S. equity markets. And it'll be interesting to see how that plays out over the course of the summer.
Yeah, I wish the EWU traded a little more active. That's the MSCI. And Russell, what's the MSCI index option symbol that SIBO now runs?
It's not an MSCI index. It's the FTSE 100. Oh, okay. And I believe it is UXTM, but not every quote vendor is carrying it right now.
All right, we got a few minutes left here on the show. I want to make sure we get some of our listeners in on the program as well. So without further ado, let's dive right on into our volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, welcome to the volatility voicemail. Easy for me to say today. We got a lot of you guys chiming in live with some interesting questions. We'll get right into it. Some of our listeners are pretty savvy. They were already asking us before we even started talking about it. They wanted to know our thoughts on XLF. So we already weighed in on that. Seems like some funky size going up out there today. We'll stay on top of that really quickly. We got a bunch of prepared ones, but I like to give the live folks some love here as well. Really quickly, Taylor, this one might be a good one for you. This one coming in live from Gabe Rich. He wants to know, how can something like a VIX be technically oversold, Taylor? That's not exactly what you were saying, but it is a similar point to, I think, going back to what you were saying earlier about maybe leaning a little bit shorter vol when VIX is low versus the conventional buy when it's cheap.
Sure. So, we don't think VIX necessarily gets oversold. What we think is that when the VIX is low, and let's take a step back. What is the VIX, right? The VIX is a representation or a calculation based on options of the S&P 500, the SPX. So if the VIX technically was oversold, there'd be an arbitrage opportunity between the VIX and the S&P, and that just doesn't really exist. All of our buddies that are making markets would take care of that pretty quickly. What we're looking more at, and this is a technical term, but it's the autocorrelation of volatility. So what it means, Gabe, is that volatility correlates to itself. It's self-correlating. It's a property that a lot of volatility traders are familiar with, but not as many of the general investing public. But because volatility correlates to itself, as it goes lower, it keeps going lower. So I don't want to confuse that with it being oversold. We just think low is not necessarily cheap. Does that make sense?
I think it does. We'll have to see if our listeners understand it. But I think, that definitely gets to the point we were saying a little bit earlier here on the program. We didn't say oversold. Sometimes our listeners like to jump in with, but yeah, they get the point of what we're saying. Let's see. We got. I want to keep asking a few more questions, but I want to get a crystal ball into it. So maybe with that, we'll table the voicemail for now. We went a little long on the interview, but it was good stuff. We want to get into a real quick crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
All right, everybody, welcome to the Crystal Ball. Taylor, if you're not familiar, this is the portion of the program where we all embarrass ourselves mightily. Actually, I didn't fare too badly last week. It was Andrew and I on the program last week, and Andrew was selling a little bit of vol. He was hovering about the 12.95 level out there in the VIX Cash. Again, this is where we prognosticate for the week to come, where the VIX Cash is going to be at showtime next week. This one was a tricky one this week because non-farms in the morning always throws a bit of a wrench into the works. You could be right in the morning and horribly wrong in the afternoon, or vice versa, depending on how that number plays out. I was leaning a little bit higher, but not much. I said about 13.5, so I guess by merits, I win over the Rock Lobster, even though I'm sure if he's listening right now, he's probably taking umbrage at that point. So this week, Taylor, since you're our guest, I will give you the dubious honor of going first. Right now, this time next week, all things considered, where do you think we'll be from a VIX Cash perspective on showtime next Friday?
So we're purely quantitative, very systematic. Everything's an algorithm, and I'm going to completely go outside that sphere, and I'm going to tell you that I think it's been a really cold spring. It's finally starting to get warm out. A lot of these traders are going to be relaxed, and I think the VIX is still going to be low. I think we're going to be somewhere around 14.25 next week. I don't think much is going to happen. Again, that is completely pulling that out of my you-know-what, as we don't like to make predictions, but there you go.
None of us like to make predictions because they're so horrible.
I don't like making predictions, but here's my prediction.
It's so painful, but we all have to do it. It's for the listeners at the end of the day, Taylor, so they can all mock us terribly afterward. I appreciate your specificity, 14.25. That's good. Mark always complains about having to go first, so I will go next to take him off the table. I'm a little bit less optimistic from an overall vol perspective, but we still do have the Fed on the horizon as of next week, so that's going to keep things from getting down, I would think, into the 11 or 12 handle. So I'm going to keep myself probably around, let's see, we're about 1380 or so right now in VIX Cash. I'm going to say we're going to be about a 13 even out there, so a little bit lower than my last week prognostication, but I'm not overall comfortable with that. Probably more. Actually, I'm going to adjust. I'm going to say 13.5. I'm going to keep it where I was this week. So there we go. A little bit of a quick change on the fly. All right, corner office, you're up next. Where are you going VIX Cash next week?
1456.
I think you just prices righted me.
He totally did.
I know. I'm just messing around. 15 and a quarter.
15 and a quarter. Okay.
I when we hit these quiet periods where you don't have anything in front of you, I keep expecting some sort of surprise. And maybe the Brexit thing starts to work its way in. Maybe concern about the overall economy really starts to take over with stocks. Yeah, I'm always, I used to work with a hedge fund guy. All he ever wanted to do was short stocks, and I think it's stuck with me my whole life. So I'm thinking bad things are on the horizon, but I can't tell you what it is.
If you said short vol, I think you were working with Don Schlesinger, but that's a conversation for another day. Bring us home, Mr. Greasy Meatball. Where are you leaning from a vol perspective next week?
Well, since Taylor won't be here next week, hopefully he'll be on soon. But next week, we'll as former Amex brethren, I'll carry his torch and go 14 1/4.
Wow. There we go.
Oh, so you're copying him so that you can get the win in case he's not here. I was thinking maybe we should make like a guest account so the guests could have some sort of aggregate score as well.
That's not a bad idea.
So maybe we'll add that in the future.
If I have to guess on my own, I'll go $1. So I'll price right all of you.
So 14.25 or $1. I'll give you that. You have that strangle on VIX next week. All right, that's about I think where we're going to have to leave it for this week, listeners. That theme music means we're done with yet another fun episode. This was a fun one, actually. I really enjoyed it. A lot of you guys chiming in on the chat there, too, and via Twitter and everything else with great feedback, so keep that coming. But before we go, really quickly, let me check back in one last time with my panelists here on the old Vol Views program today. Starting off one last time, Taylor, one last time. If listeners are intrigued by everything you were talking about today here on the program, the Smart Volatility Fund, they want to learn more, where should they go? What should they do?
Well, you can go to www.volfunds.com, that's volfunds.com, and learn more about our mutual fund and how we employ smart volatility.
There you go, listeners. Check it out for yourselves if you're intrigued by all the stuff Taylor was talking about here today. And Mr. Greasy Meatball, if people are so inclined to venture to the realm of the Pit or Carmen line, where should they go? What should they do?
Well, we're going to be doing some fun things in July. I believe that the link will be in the show notes, but in July, we're doing the Option Pit SIBO Professional Traders Summit. You come into Chicago, you hang out with me and Russell and Mark. You go to a Cubs game, you go to a steak dinner, and then and you get a lot of learning on. I believe there will be a link to get registered for in the show notes. But it's going to be July 19th through the 22nd. And it's going to be a great time. So if you can clear up some time in Chicago, come and visit us. That's the best time to be here.
Yeah, July in Chicago. You can't really beat that. And we may even do a few live shows there from that event. So if it's always been your life's dream, your bucket list, listeners, to watch us do one of these programs, not just stream it live, but be there in person, here you go. Now is one of your rare opportunities to do just that. And last but not least, Mr. Rhodes, I know you're traveling hither and yon, but what's cooking in the land of the CBOE Options Institute, as well as with our friends over there at CBOE Live Vol?
Well, I'm in San Francisco, and I'm doing a OIC event tomorrow. But next week, I can't believe Mark Sebastian forgot this.
Oh, yeah.
Yeah, the CFA Chicago chapter, which I'm a member of, and the OIC have gotten together, and we're doing 2 panel discussions. Joe Burgoyne's going to do one on institutional option usage, and I am going to do one on volatility of all things. And after asking about a dozen people who turned me down, I got Mark Sebastian on the panel, along with one of the Thompson twins, Mike Thompson, from over at, what's the name of their firm now, Mark Sebastian?
They're at Kaizen.
And then Mark Shore from over at DePaul, who has updated a really nice paper about trading VIX futures versus VSTOXX futures. So we're going to venture beyond CBOE volatility products in that panel discussion as well. And there are spots left. You can go to the CFA Chicago.org site and sign up to attend that on Wednesday evening.
That panel is just a bunch of Options Insider regulars. I'm going to have to go check it out for myself. And on behalf of Mr. Corner Office, a.k.a. Russell, and, of course, the Greasy Meatball, a.k.a. Mark, and, indeed, our guest, Taylor, from all things ABR, dynamic funds, and smart volatility related, and, indeed, myself. I want to thank all of you out there in the listening audience for downloading, streaming, subscribing, for streaming live, and, of course, for sending in such great questions. Keep them coming, and we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.